We will now prepare the integrated financial statements. This involves reducing or condensing the level of detail in the raw historical data into a select few line items that we need for valuation purposes. Every line in the raw historical income statement and balance sheet can be included somewhere in the integrated financial statements. Let's run over some of the select line items that I've chosen for this particular model. We will begin with the income statement. The first line in the integrated income statement is sales revenue. Included within this line item are the direct revenues generated by the company. The next line is cost of sales. Included within this line are the direct costs incurred to generate the revenues in the line above. It should be relatively easy to identify the cost of sales figure in the income statement of a company that sells goods. However, if the company is engaged in the provision of services, it may be more difficult to identify the direct costs or cost of sales figure in the company's income statement. Service providers tend to include cost of sales under various account titles. The next line item is operating expenses. Included within this line item are the other, more indirect costs of operating. Throughout this model, I will make a distinction between operating and non-operating items. This distinction is important for the integrated financial statements. An item is classified as an operating item if it relates to the company's core operations or business, and it is recurring in nature. In other words, it is expected the item will recur year after year. An item should be classified as a non-operating item if it relates to non-core activities of the company, or it is non-recurring in nature. For example, Tesscow is a grocery retailer. If Tesscow sells one of its buildings and manages to generate a profit on the sale, the profit on sale should be classified as non-operating income. This is because it does not relate to the core business of Tesscow, which is the retailing of groceries, and it is not recurring in nature. The income is irregular or once-off. The next line item is depreciation. We need to keep depreciation as a separate line item. We need depreciation in order to calculate free cash flow. A component of free cash flow is CapEx less depreciation. Therefore, we need to have the depreciation figures for each year on hand. You may have to extract the depreciation figures from another line item. For example, with FAME, depreciation expense is included within administration expenses. To get depreciation as a separate line item, I had to extract it from administration expenses. Depreciation expense is followed by non-operating income and non-operating expenses. These accounts will include any income and expense items from the historical financial statements that relate either to non-core activities of the company or are non-recurring in nature. These line items are followed by interest income and interest expense. I've also netted off interest income and interest expense to arrive at a figure for net interest. The reason why I've done this is due to the plug that I've chosen in the balance sheet, which is net debt. Net debt is an amalgamation of cash and cash equivalents and the long-term debt of the company. We'll discuss the concept of the balance sheet plug further in a moment. Next, we have the reported taxes of the company from its income statements. All of the above line items allow us to arrive at a figure for net income for each year. Now let's turn to the balance sheet. The first line in the balance sheet under assets is net working capital. This is another important line because the change in working capital, its increase or decrease year on year, is a component of free cash flow. The balance sheet accounts that we will capture will be the balances of working capital at the end of the year, or their carrying amounts or net book value. What we need to calculate free cash flow is the change in working capital. In other words, the change between the balances year on year. We will extract the change between these balances at a later stage. So what should be included in this line? What should net working capital comprise of? Working capital is equal to the current assets of the company less its current liabilities. There are 2 points to note here. In the model we are building, we will exclude cash and cash equivalents from working capital, although they are current assets. This is because of our choice of plug, which is net debt. The net debt plug will include the company's cash and cash equivalents. The second point is net working capital may be positive or negative because the equation is current assets less current liabilities. If current assets exceed current liabilities, we have positive working capital. If current liabilities exceed current assets, we will have negative working capital. In other words, our suppliers are effectively providing short-term, probably interest-free finance to the company. The next line item is net long-term assets. This is another important component that we need to calculate free cash flow. This line item represents the assets that comprise of the long-term productive capacity of the company, such as property, plant, and equipment. Once again, these cells will capture the balance sheet balances or the carrying amount or net book value of the company's long-term productive assets. The changes between these level of assets are what we need to calculate free cash flow. We will extract the changes between the years at a later stage. The next line is goodwill and intangible assets. Goodwill and intangible assets would usually be kept as separate line items within the model, but we are building a very simple model. You could argue goodwill and intangible assets are a vital part of the long-term productive capacity of the firm, so why not lump them in with the net long-term assets line? There are good reasons why they should be kept on separate lines. Firstly, in relation to goodwill, goodwill should represent value stemming from often complex intangible sources, such as synergies or customer loyalty. But accounting rules are restrictive when it comes to the recognition of these assets on the balance sheet, and therefore the goodwill that we typically see being recognized on the balance sheets of companies has arisen from acquisitions, where the company has acquired another firm and paid more for that firm than the book value of its net assets. Most acquisitions fail to create additional value. Therefore, we have to be careful with how we forecast goodwill. Secondly, in relation to intangible assets. Intangible assets may include valuable assets to the company, such as intellectual property. In some industries, such as tech, intangible assets can be significant and valuable assets to the company. In this case, we should list intangible assets separately within the model and give careful consideration to how we forecast or predict the future value of these assets. Next are non-operating assets. This line item will include all other categories of asset that don't fit into any of the other line items. Now, let's turn to the liabilities section of the balance sheet. Net debt is the balance sheet plug that I have chosen for my model. The plug is the mechanism that we will use to make the balance sheet balance over the future or forecast period. The plug I have chosen to use is comprised of cash less long-term debt. Bear in mind this is a very simplistic plug. There are far more sophisticated plugs that can be used. However, they are beyond the scope of this presentation. A few points to note about the plug. Firstly, the chosen plug can be positive or negative. Remember, it is defined as cash less long-term debt. If the company's cash reserves exceed its long-term debt, the plug value will be positive. And if the long-term debt exceeds cash, the plug will be negative. The second point to note is net debt is related to net interest in the income statement. My choice of plug is why we combine interest income and interest expense on the income statement to arrive at net interest. It is the company's cash and cash equivalents that will most likely generate the majority of the interest income, and it is the company's long-term debt that will primarily drive interest expense. If the plug combines cash and long-term debt, it makes sense to combine the product of the net debt plug, or the net interest, in the income statement. Next is non-operating liabilities. These are all other liabilities that don't fit into any of the other line items. Now let's turn to the equity section of the balance sheet. Paid-in capital includes the equity accounts that represent the original investment or contribution by shareholders of the company. In the United States, this will include the paid-in capital account. Outside of the US, this will include the share capital and share premium accounts. Retained earnings will include the accumulated or retained profits of the company. We will insert the actual figures for retained earnings into the historical period. However, over the forecast period, we will derive the retained earnings figures using this reconciliation below. This reconciliation assumes clean surplus accounting. In other words, retained earnings equals total profits which have gone through the company's income statement since it was formed, less the total distributions or dividends paid out since the company was formed. Clean surplus accounting assumes the only changes to retained earnings go through the income statement or distributions in the form of dividends. For the historical period, we only need to enter in the dividends paid from the statement of changes in equity. We will need these figures for forecasting purposes. The retained earnings figure over the forecast period is derived from this reconciliation. The retained earnings figure will be derived from opening retained earnings plus income from the company's income statement figure less the expected dividend payout will give us the closing retained earnings figure for that year, which will populate in the integrated financial statements. The other comprehensive income section of the balance sheet is where we will list all other equity accounts that we find in the company's balance sheet that are not original capital contributions or retained earnings. We should be able to place every line item from the historical income statements and balance sheets of the company somewhere in the above line items of the integrated financial statements. As a result, the net profit figures in the integrated financial statements should tie back to the actual reported net profit figures in the company's actual income statements. In addition, the integrated balance sheets that we prepare should balance. In other words, total assets should equal total equity plus total liabilities. It is important to check this to ensure the model is complete, and we haven't left out any line items from the actual income statements and balance sheets of the company. Now that we've defined the line items in the integrated financial statements, let's populate the cells with the data from the raw historical financial statements. Let's begin by populating the integrated income statement figures. It's important to highlight a couple of points before we get started. Firstly, classifying accounts into the integrated line items does involve a certain level of judgment. Secondly, for time reasons, I will move through the classification of the accounts and the population of the cells quickly. However, in practice, this would need to be done more carefully. I have now finished populating the integrated income statement figures. To make sure I haven't left out any line items, I can check that the net income figures per the integrated income statements agree to the net income figures per the raw historical data. I can see that the balances agree. We can now move on to populating the integrated balance sheets. Let's begin with net working capital. Remember, net working capital equals current assets less current liabilities. I won't include cash in net working capital because we will be including it in the net debt plug. I will now scrutinize the current assets and the current liabilities sections of the balance sheet in order to identify any accounts which should be included in net working capital. From the current assets section, I will include stock or inventory, trade debtors, other debtors, and prepayments. From the current liabilities section, I will include trade creditors, accruals, and other current liabilities. We can see the net working capital figures are negative over the historical period. The company has negative net working capital because its current liabilities exceed its current assets. Next, I will populate the cells for the net long-term assets line item. I will scrutinize the non-current assets section of the balance sheet for any accounts that should be included within this line. From the non-current assets section, I will include land and buildings, fixtures and fittings, plant and vehicles, and other fixed assets. I will again scrutinize the non-current assets section for any goodwill or intangible asset accounts. I will use the non-operating assets line item to include any asset accounts which have not yet been included in any of the other line items. From non-current assets, I will include non-current investments. I've made a choice to include non-current investments in non-operating assets. You could also reasonably include this account in the net debt plug. From current assets, I will include group loans and deferred tax assets. I will now turn to the liabilities section of the integrated balance sheet. I will begin by populating the cells for net debt. Remember, net debt is our plug and it's comprised of cash less the long-term debt of the company. I will begin by scrutinizing the current assets section of the balance sheet for any cash reserves of the company. I will include bank and deposits, current investments, and from the current liabilities section, I will include short-term loans and bank overdrafts. These accounts comprise of the company's cash position. I will now search the non-current liabilities section for the company's long-term debt. Under the non-current liabilities section, I will include long-term debt and other long-term liability accounts. We can see the net debt plug is negative over the historical period. This means the company's long-term debt exceeds its cash reserves. I will use the non-operating liabilities line item to include any other liability accounts that have not yet been included in the other liability line items. From current liabilities, I will include corporation tax and Social Security and VAT. And from non-current liabilities, I will include deferred tax liabilities, other provisions, and the company's pension liabilities. I will now compile the equity section of the integrated balance sheet. The first account is the contributed capital of the company. I will scrutinize the equity section of the balance sheet for any accounts that represent the contributed capital by the shareholders of the company. I will include issued capital and the share premium accounts. For the retained earnings line item, I will include the profit or loss account. The other comprehensive income section of the integrated balance sheet is where I will list all other equity accounts that are not included in the contributed capital and retained earnings line items. If I look at the equity section of the balance sheet, I can see there are other reserves and balance sheet minorities or non-controlling interests. I need to list these other equity accounts under this other comprehensive income section. Finally, I need to list the dividends paid in each year over the historical period from the statement of changes in equity. I won't need these figures just yet, but I will need them when it comes to forecasting future dividends. I've now finished populating the integrated balance sheet figures. To make sure I haven't left out any line items from the raw historical balance sheets, I can check that the balance sheets balance. In other words, the total assets equal total liabilities plus total equity. I can see that total assets equal total liabilities plus total equity for each year. So I'm confident that I haven't left out any balance sheet accounts from the raw historical data. I have now finished preparing the integrated financial statements for the historical period.